When it comes to real estate investment trusts, or REITs, a common misconception among investors is to view them solely as income generators. Indeed, REITs are designed with income in mind. This distribution often leads to attractive dividend yields. However, it's important to note that REITs can offer more than just dividends. They can also provide solid capital gains and overall returns that outperform the market. Don't assume that high dividends mean limited growth potential. In today's world, market dynamics are different. Recent market conditions have caused the share prices of many REITs to drop. But here's where it gets interesting. When a REIT's share price falls significantly below its actual value, it's not just about income anymore. This situation is often referred to as a margin of safety, or simply a discount.
Big shout out to Seeking Alpha for sponsoring our video and its analytics. Make sure to get your 14-day free trial of Seeking Alpha Premium via the link in the description. You can only get the 14-day trial through the link below, so make sure to check them out, guys.
When a stock trades at a considerable discount, it transforms from being just a dividend source to a value investment. And this is where the potential for significant returns comes into play. As the market realizes its misjudgment and corrects the REIT's valuation, its share price could rise due to multiple expansion. In simpler words, when the market acknowledges its mistake and adjusts the REIT's value upwards, investors can benefit from both dividends and growth. The current uncertainty around REITs could be an opportunity in disguise. It might enable investors to enjoy passive income and strong capital appreciation simultaneously. The recent downturn in real estate investment trusts has raised concerns among investors, primarily due to the impact of rising interest rates. Often considered as income-oriented assets, REITs have shown sensitivity to shifts in interest rates. However, understanding the nuances of this relationship and the broader investment landscape is essential to make informed decisions. The correlation between REIT prices and interest rates is rooted in the concept of risk. As risk-free rates increase, the demand for REITs, which are considered risk assets, tends to decrease. This relationship becomes evident when comparing high-yield equities like REITs with lower-risk options in fixed income. While comparing bond yields to REITs, dividends might seem logical for risk-averse investors seeking immediate passive income, it's important to realize that bonds aren't flawless investments. Recent years have seen notable fluctuations in long-duration bonds, leading to losses for investors. In this context, the Vanguard Extended Duration Treasury Index Fund ETF has recorded a significant drop in value. Contrary to the prevailing market sentiment, REITs possess the potential for both high dividends and robust capital appreciation. Blue-chip REITs offer stable high yields and steadily growing fundamentals, contributing to long-term share price growth. This is a key reason why equities consistently outperform fixed income assets over extended periods. While short-term treasuries and money market funds currently offer appealing yields, history indicates that a hawkish rate cycle rarely results in a smooth economic transition. The likelihood of a recession following interest rate hikes is high. Subsequent rate cuts are then used to stimulate economic growth, leading to declining yields on short-term bonds and money market funds. Predicting macroeconomic shifts like these remains challenging. Instead of attempting market timing, it's more advantageous to concentrate on the fundamentals of individual stocks. Unlike bonds, stock sales, earnings, and cash flows are more predictable, allowing for more informed investment decisions. A significant drawback of bonds as passive income vehicles is their lack of growing fundamentals. Their static yields lose purchasing power to inflation over time. In contrast, stocks that consistently grow dividends offer a solution. Annual dividend raises counter inflation, ensuring retirees' quality of life improves over the years. Blue-chip REITs exemplify the potential of growing dividends and stable fundamentals. These dividends are a reflection of the underlying growth that stocks generate over the long term. Despite the current market downturn, well-selected REITs hold significant upside potential for investors seeking to balance passive income and capital appreciation. Understanding the underlying factors driving REIT performance and the broader investment landscape can dispel the fears surrounding interest rate impacts. While the relationship between REITs and interest rates exists, it's crucial to recognize that other dynamics, such as growing dividends and robust fundamentals, play a vital role in their long-term value proposition. In this complex investing landscape, A balanced approach that considers both income and growth potential can yield favorable outcomes for investors. Realty Income is not only one of my favorite real estate investment trusts, but it's also a prime example that supports the case for stocks over bonds in today's market scenario. Let's break it down. Currently, Realty Income's shares yield about 5.23%, which is pretty close to the 5.38% yield of the SPDR Bloomberg 1 to 3 month T-bill ETF. Often seen as a lower-risk investment, you might be thinking, why choose Realty Income when BIL seems to offer higher risk-free yield? Well, the answer is simple. Realty Income comes with growth potential that BIL lacks. Sure, stocks carry inherent risks, and no dividend is a sure thing. However, Realty Income, or O, as it's known, is a strong contender for dividend safety. Here's a fascinating fact. Realty Income has consistently paid monthly dividends for over 53 years, declaring its 637th consecutive monthly dividend recently. Since going public in 1993, the company has raised its dividend annually, maintaining a 30-year streak. In terms of dividend growth, Realty Income's 5-year rate is about 3.73%, almost double the Fed's annual inflation target of 2%. While high inflation may have impacted dividend growth recently, the company's history suggests it's likely to continue increasing dividends. Looking ahead, I anticipate Realty Income will maintain around 4% annual dividend growth for shareholders. If we project the current annual dividend of $3.07 per share over 5 years, it could reach around $3.70 per share by 2028. This projection results in a 6.31% yield relative to today's share price of $58.62. Comparatively, this yield is approximately 1% higher than BIL's yield. Plus, Realty Income's dividends are likely to keep growing, making it even more appealing over time. Considering the recent 8.12% year-to-date drop in Realty Income shares, they are now trading at an attractive blended price to AFFO ratio of only 14.78x. Looking forward to 2023, with a consensus AFFO, adjusted funds from operations, estimate of $4, the forward price to AFFO multiple would be approximately 14.65x. In simpler terms, Realty Income offers a compelling blend of steady income and the potential for capital appreciation. Despite market ups and downs, it stands as a strong option for investors seeking both passive income and long-term growth. Today, Realty Income's valuation is one of the lowest it's been in recent decades. Typically, such low valuations were seen during major economic downturns like recessions. For instance, during the worst of the COVID-19 crisis, O shares dropped to around 13 times their value, and during the Great Recession, they reached about 9 times their value. However, these were unusual events. Generally, O shares are quite affordable now compared to their historical averages. Both the blended and forward price to AFFO multiples are well below their average multiples over 5, 10, and 15 years. This is despite the current high interest rate environment. Surprisingly, O is still managing to grow its financials. In 2023, O has reported strong performance in the first 2 quarters, and its management maintains a positive growth outlook. During its Q2 report, O showcased 2% growth in same-store rent, 3% growth in AFFO, raised its investment guidance by $1 billion, and lifted its normalized FFO guidance range. In an ideal world, this growth should lead to higher dividends and share prices. But the market doesn't always behave rationally in the short term. It's often influenced by fear and greed. Right now, the fear of rising interest rates is spooking investors, but once the Federal Reserve adopts a more accommodative stance, greed could lead to a rally in shares. So, why wait? Rather than chasing momentum and hoping for soaring prices, I find it more appealing to buy shares of a reliable REIT, like O, when they're down. Currently, I believe investors purchasing O shares are getting a margin of safety of about 17%. Our fair value estimate for O shares is $70.30, which translates to a multiple of around 17.5 times our 2023 AFFO expectations. Due to this discount, if O reaches our fair value target, investors who buy now could see gains of around 19.92% on their investment. Adding in the stock's 5.2% yield, This could lead to a short-term total return potential of approximately 25%. This kind of potential is hard to match with short-term bond ETFs. In conclusion, this example showcases how a top-tier REIT offers a strong case for both income and total returns in today's market. We track over 100 REITs, and there are many other opportunities like this due to the recent sector sell-off. This could be one of the best times to invest in REITs in recent memory.